All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be talking about protectionism, okay, opportunity cost, and employment. All right. Now, when it comes to protectionism, we've talked about protectionism in the past few videos. Okay, protectionism has to do with tariffs, okay, input quotas, okay, as well as certain kind of paperwork that restrict trade in general. All right. Now, if because of protectionism, okay, let's say the industry is protected, a certain industry within a country is protected because of protectionism, because of tariffs, for example, then comparative advantage is not taken into account. All right. And we've talked about comparative advantage when we compared comparative advantage with absolute advantage. Comparative advantage had to do with, okay, the opportunity cost, okay, of producing something. Okay, so the country, for example, with the least opportunity cost of producing a product wins the trophy of comparative advantage. Okay, or in this case, the company that has the least opportunity cost of producing a product, okay, wins the trophy of comparative advantage. Comparative advantage, okay, this is your least opportunity cost. Okay, this is your comparative advantage. This is the least opportunity cost as far as the protectionism is concerned. Okay. Okay, and in this case, the product, okay, may be produced at a higher cost. The product may be produced at a higher cost. All right, so the cost of production goes up. All right, now as a result of which the consumers pay more, okay, for production, let's say at home, okay, domestic production. This can work both ways. The consumers either pay more for an imported product, in which case, okay, they have less to spend in other industries, okay, at home, or they pay more for the same product, okay, where the domestic producers do not have the capital investment to make that product, as a result of which, okay, they end up paying a higher, let's just say, um, higher in terms of the retail value. Okay, so they pay a higher retail value for the same product. Now, when they pay a higher retail value, okay, they're technically paying for lost economic inefficiency. Okay, because that retail value is high because the cost of production is high. The cost of production is high because the firms do not have capital investment, okay, to save on production. As a result of which, the consumers they end up paying more because of production and economic inefficiency. Okay, so consumers pay more, consumer pay more, consumers pay more for economic or production inefficiency. This is production or economic inefficiency. All right. And because consumers pay more because of lost economic inefficiency, okay, obviously their profit is less. They're making less in profit. Okay. Um, when it comes to saving money. All right. And the payment that they make, okay, the price, the retail price they pay towards a product, okay, doesn't make the retailer rich as well. Okay, because obviously the money is lost in economic or production inefficiency, as a result of which the retailer or the distributor or the manufacturer is not able to create jobs because the money paid by the consumer is not going towards employment. All right, so because of this inefficiency, money is lost, okay, and money is not going towards creation of employment. All right, so that has to do with comparative advantage. Now, the second one has to do with, okay, the allocation of money in general. Okay, so when consumers pay a higher price, let's say either to a domestic producer or an imported product, okay, the money is not necessarily allocated, okay, towards employment creation. All right, the money may go elsewhere. Let's say under sales and marketing, okay, where the employer might be paying more to a third party, okay, and they may be doing the work by themselves, okay, they may not be hiring um, employees, all right, so, or it could be under automation, okay, it could be um, sales and marketing online, for example, okay, which may not require a lot of people in terms of employment. Okay, so that's one example. Okay, and the other example would be a allocation of money, which means money could be going towards their savings account for further or future business expenses. Okay, it could be going towards investment products. Okay, to secure the business and business profit to save the business from bankruptcy. Okay, so on and so forth. So the allocation of money doesn't necessarily go towards employment creation. So this has to do with allocation of money. So this is money allocation. Okay, not necessarily towards employment creation. Okay, it's not necessarily. Not going towards employment creation. All right. So these are two ways the price that consumers pay, the high price that consumers pay towards a product, okay, or for a product, does not necessarily mean that jobs are being created, okay, because that money is lost elsewhere, okay, whether because of economic and production inefficiency, okay? Or it could be because of allocation of money elsewhere, such as towards investment products, okay, towards business expenses that are not relevant to employment, okay, so on and so forth. Okay, so that would be it for this video. On behalf of V Electronics, this is Obey. Have yourself a great day.